Now, David Hershey is a CFA, Certified Financial Analyst, Managing Director and Principal of Lotsoff Investment Professionals here in Lotsoff Capital Management here in Chicago. It's a leading pension fund management firm. He started his career with 6 years in the banking industry, focused primarily on interest rate risk and management. First at the Federal Home Loan Bank Board, the Thrift Regulatory Agency in Washington, D.C., evaluating and reporting on financial condition of thrifts throughout the Midwest and Texas. Then People's Savings Bank in Chicago, where he was in charge of asset liability investment management. He joined Lotsoff in 1989, lead portfolio manager on Lotsoff's Intercap portfolio. From its inception, presided over its growth to $1.5 billion with a B in assets. Mr. Hershey was senior consultant for Lotsoff's financial institution consulting business from '89 through '98, in addition to being a portfolio manager for Intercap. He managed and tactically traded the core portfolio primarily in mortgage agency and asset-backed areas, beginning in mid-2000. He took over full-time strategic and tactical decision-making for the core bond portfolio most recently. Mr. Hershey launched a new long-duration core bond product. The strategy is designed specifically for pension plans to reduce tracking error and earn an annual surplus of over 300 basis points over the Lehman Treasury Index. It's written extensively on pension plan investment strategy with articles published in Pensions and Investments and Employee Benefits Journal. He's been an invited speaker at several pension. They're very careful methods of investment. I met David through the Henry George office here, and this was about 4 years ago. David became one of the people helping to get the Lost Science of Money book into print. In other words, he helped financially to back that book. And one day, about a year later, I picked up the Chicago Tribune. You know the Chicago Tribune. Everybody knows the Chicago Tribune. It's the main paper here. And there on the front page of the business section is a giant photo this large of David Hershey in color. And I thought, wow. Anyway, please welcome David Hershey.
Thank you, Stephen, for that fine introduction, and thank you for all being here. I'm delighted to be here with this group of high-minded and upright individuals. If you're for monetary reform the way that Stephen has described it, I know you're a wonderful group. I'm here today to talk about a remarkable man, Frederick Soddy. I wonder how many in the group here know Frederick Soddy, are familiar with his work? Oh, good. Good portion of you. Frederick Soddy was born in England back in 1877. His career spanned and was highly influenced by the two world wars. He died in 1956. He was a man driven by this insatiable thirst for understanding and this unbreakable sense of justice. His values sent him at age 25 over to cross the Atlantic to Montreal, Canada, where he worked with a man named Rutherford on a series of papers that described atoms and proved that they were real and physical and not invisible materials, which was widely believed at that time. Rutherford was a senior partner in their collaborative effort, and it was to Rutherford that the Nobel Committee awarded their prize back in 1902. Soddy would have to wait for his Nobel Award, and he received the prize in 1921 for his work with Ramsay. They had discovered the chemicals with identical elements but with different atomic weights, which Soddy named isotopes. So the winning of the Nobel Prize at age 44 marked the pinnacle of his work, and it also marked the turning point in his career. He was named the head of the chemistry department at Oxford at that time, but he turned his attention away from the physical science and to social concerns. He spoke out on the need for scientists to act as responsible citizens, and at that time, conventional wisdom was that science pursued objective truths and they could not be held responsible for the consequences of those truths. But Soddy saw things differently. He was very concerned about the uses which mankind might make of his findings on atomic energy and atomic weapons. And he saw energy at the heart of the wealth creation process, and he wanted to see its benefits distributed throughout the world to everyone who deserved it, and not just concentrated among the rich and powerful. He saw that atomic knowledge could be used to create bombs, and he was terrified about their influence on modern warfare. The novelist H.G. Wells, who wrote a tremendous number of books, very prolific writer, was intrigued by Soddy's writings and based his book, War of the Worlds, on Soddy's idea. There was even a character in the book that resembled Frederick Soddy. So his research and writing into the science of money in the 1920s made him an anathema and an outcast among the physicists and chemists and his colleagues at Oxford. This is documented in a biography called The World Made New by Linda Merrickx. And some of the quotes in that biography about him were, his colleagues at Oxford would call him obstinate and uncooperative. They steered students away from his classes and lectures. They denied him research funds. They called him a crackpot. And they said he was absorbed by this foolish idea that the national economy can be analyzed by the same principles as thermodynamics. In short, he was shunned, he was mocked, he was insulted. Clearly, his writing about monetary theory had upset people. His mature thoughts were contained in a book called Wealth, Virtual Wealth and Debt that was published in 1926, which I highly recommend to you. Since his death, the prophetic and courageous aspects of his thoughts are widely appreciated. Clearly, he was right about the danger of atomic bomb and the caution we must exercise with regard to atomic energy. And his views that being a scientist does not absolve one from the moral responsibility and consequences of his work is now widely regarded as true. But still, his keen insights on monetary issues remain neglected, which is what I'm here to speak to you about today. Even in this otherwise sympathetic biography by Merrickx, Soddy's monetary theories received short shrift. She says, no one knew in the 1920s whose monetary theories were correct. Was it Arthur Kittson's theories, who was widely read at that time, Frederick Soddy's, or John Maynard Keynes? She says, Merrick, the biographer says, it's only with the benefit of hindsight that we know that Keynes' theories have triumphed. It never seems to occur to her that Keynes' theories gained ascendancy over Soddy's, not because they were more correct, but because they serve the self-interest of the powerful. So, who am I to speak on this subject? This is a subject that's fascinated me all my life. I'm one of those fortunate few people that discovered my vocation early on in life. At age 13, I knew I wanted to pursue a career in money and banking. There's something about the movie It's a Wonderful Life that really captured my imagination. Perhaps it was the central role of Mr. Potter and George Beatty, who played in the community of Bedford Falls. I had this sense that money and banking were fundamental to justice in the community, and I wanted to be at the center of that nexus. And I assume that we've all been exposed enough to this Hollywood reruns of the show that I don't have to recount the details of this David-like figure, George Bailey, who plays the savings and loan manager and who struggles against the greedy banker Goliath, played by Mr. Potter. But I recommend you buy the DVD, It's a Wonderful Life, like I did, and make it a part of your holiday tradition without needing to sit through all the commercials that NBC regularly spoils it with. So to pursue my career in money and banking, as Stephen indicated, I received all the necessary degrees in Bachelor's of Science in Finance and an MBA, and even passed the CFA test with all their, just 3 years of testing required to go through that. But it was clear to me at a young age that what I was learning in the classroom wasn't the complete story. And so while I was still in college, I began this lifelong quest to try to understand the mystery of money and banking. And I did a lot of outside reading, and I was deeply involved with those who were considered masters of this subject. And as Steve said, my first job out of school was a federal bank examiner. I did that for 2 years, and then I went to work as a treasurer at a bank for 6 years. And then in 1989, I joined Lots-Off Capital Management here in Chicago, where I've been involved on a daily basis over the past 17 years with the bond markets, the currency markets, and the equity markets. And I've had the good fortune to meet and talk with almost every major Wall Street economist. And my first inclination in the study of money and banking was to embrace the commodity concept of money. Gold, sounded to me like honest money. And I became a member of this Austrian School of Economics, and I even taught classes in the subject. I was completely oblivious that I was traveling on the road to perdition here. But in spite of all these high-level contacts and all the outside reading I've done, I mark it as that single most important step on my journey for an education when I met Stephen Zarlinga here 7 years ago. We met over at the Henry George office. Chuck Vitalitz, the president over there, knew that we were both students of money and banking, so we arranged the meeting. And through Stephen's patience and hard work, my eyes were finally opened to the subject, and I owe him a tremendous debt of gratitude. Thank you, Stephen. And as Steve said, our first meeting at Chuck's was 2 hours, and I found him, I found Stephen quite interesting. But as for his ideas on monetary reform, I was largely unconvinced. But I was putting on my coat, and I was leaving the office, and Steve gave me those parting words about fiat money, and part of it was it's immoral for private banks to usurp the value of the public seigniorage. And his words really stuck with me, and I found them very profound and irrefutable. And The Lost Science of Money was not yet published when I first met Steve, but he would forward me chapters, and I would devour his every word, and I would read him and reread him, and I just thought it was brilliant. And I'd come back to Stephen with questions, and I did a thorough study of his bibliography. If you read those book reviews on Amazon, as I'm sure some of you do, one of the stock phrases people use in their reviews is something like, "The last chapter alone is worth the price of this book." Someone might say, in Ralph Ellison's Invisible Man, the fight scene alone is worth the price of the book. But I'd use this cliche with regard to The Lost Science of Money, even though Stephen's writing is superb. It's the bibliography alone is worth the price of the book. And as a side benefit of studying the ideas contained in Steve's book, I was able to conceive of these major reforms in the pension plan market. And I began writing on these ideas in 2002, and they really turbocharged my career. Within months of the publication of my first article, I went from being this lowly bond portfolio manager to a highly sought-after speaker and writer. And my pieces have been widely published in the industry magazines and newspapers, and I've been invited to speak at conferences all over the United States and several times in London. The savings for retirement it really makes up the great majority of the assets under management in this country. And because folks accumulate assets so they can maintain their standard of living after they stop working. And by using some of the concepts developed by Stephen and by Frederick Soddy, I, along with a handful of other individuals in this country, are revolutionizing the way that people think about investing for retirement. And so today I primarily want to apply Soddy's idea to the money and banking issues, but towards the end of the talk I will explain how we transferred these concepts to pension investing. So I'm here to discuss what I think are the money and banking reforms that we should emphasize. In my mind, I think we need to resurrect and put back into circulation this concept of usury. For centuries, leading social commentators and philosophers found the concept indispensable. The Jewish prophets, Aristotle and the Greeks, the Muslim community in the Quran, and among the church fathers and the scholastics, all considered usury an evil, a sin, at the heart of the master-slave relationship. And this is an invaluable insight that we need to bring back into circulation again. And once again, the credit goes to Steve's pioneering work and the prominent place he assigned to usury and the lost science. So what is usury? My definition is very close to Stephen's. Usury is the misuse of the monetary mechanism to cheat people out of their wealth. This is not the common way people think about usury. According to our definition, usury is not about lending at abhorrently high interest rates. Usury is not about eliminating seed capital to entrepreneurs or lending at interest for legitimate business enterprises. I highly recommend to you two of the best books written on usury in the 20th century, and they're listed in Stephen's bibliography if you want to try and locate them. But just be forewarned, they are demanding works, but are a rewarding study. I'm referring to Bernard Dempsey's interest in usury and John T. Noonan's The Scholastic Analysis of Usury. Both authors conclude that in today's economy, the primary perpetrator of usury is the commercial banking system, with its ability to create checkable deposits out of nothing. And that's the heart of the reform measures I want to talk about here today. To me, everything else is a distraction. These are the reforms for which we should fight. Mr. Potter wants to convert his wealth into debts so that he can live off the labor of others. But George Bailey wants to create more wealth, to distribute it fairly, and to implement a sound monetary system that eliminates usury. So what are the reforms that we can advocate to eliminate usury? With Soddy as a guide, I think there's three basic reforms we should emphasize. A, grant the state a monopoly on the issuance of money. B, require banks to hold 100% reserves behind every demand deposit checking account. And C, an inflation target monetary policy. And I think probably the members of this group are familiar with all three of those issues, so I won't bore you with all the mechanics, but I will talk briefly on each of them. First, a state monopoly on the issuance of money. The problem is that the first spenders of the newly created money receive an unearned benefit. So the solution is to collectivize the benefit by making the state the first spender, so we spread that benefit around to all of us equally. But to show why this is a problem, we need to run through quickly how banks create money. The reason that they're able to disguise what they're doing so well and so few people have a grasp on it is the banks do not really own the money that they create, and the banks do not really spend the new money that they create. As you know, there's two types of credit transactions. In a genuine credit transaction, the lender is required to give up his wealth over the term of the transaction, but in the fictitious credit transaction, the lender gives up nothing. So we're going to look at the fictitious credit transaction. Banks create the fresh balance on the borrower's demand deposit account and create a fresh loan balance from which they can charge interest. So the banks create the new money out of nothing, and they do so for the purpose of collecting the interest on the loan. They earn in quotes, they earn the interest on the loan they created when they added the new money into the loan customer's checking account balance. Now, some may counter and say that, well, at least they pay interest on the checking account that they created, but that's not the essential part of it. The primary concern, and what the banks are concerned about, is the net interest spread that they're earning between the rate they charge on the loan versus the rate that they pay on the checking account. Their ability to create the checking accounts out of nothing is what allows them to earn the net interest spread. And the borrower who takes out the new loan doesn't do it just in order to have a larger account balance at the bank. The borrower takes the new money and he exchanges it very quickly into wealth, and he will attempt to purchase and combine the land, labor, and resources in such ways to produce something that will earn him or her rate of profit in excess of the loan rate. And what's missing in this, what most people ignore, is the existing money holders lose out. The value of their claims or money is devalued proportionate to the supply of the new bank credit that was created. So the borrower gets the benefit of buying goods at the currently prevailing price level, and the rest of the community suffers a loss in the purchasing power of their money. Now in the U.S. today, over 90% of our money, again in quotes, is not in the form of the state-issued paper money, but in bank-issued demand deposits. There's about 740 billion in currency outstanding and about 7 trillion in bank checking accounts outstanding. Now, if the bank checking accounts grow at 3% a year, that's a conservative number. The purchasing power of our value of our money balances declines by 3% a year, and that's a transfer of wealth of about 200 billion per year into the pockets of the borrowers or the first spenders of the loan, and out of the pockets of everyone else who holds cash balances. But by making the state the issuer of the money, we collectivize this benefit, and the state gets the benefit of being the first spender of the new money. And the state's able to spend the money into existence and buy at the prevailing price level, and that benefit is spread throughout the community by lowering the community's tax burden by the amount of the new money spent. So the state benefits by being the first issuer, and it doesn't have to give up anything in exchange for the new wealth. And in the case of the bank that created the fictitious money, the borrower is able to buy at the prevailing price levels, and the existing holders of the money lose the value of the additional supply. So this is the reason why we should make the state the monopoly issuer of money to collectivize these benefits. And then by allowing the state to spend money into existence, we equivalently reduce the amount of the tax burden. We must address the concerns of those who don't trust the state to manage the currency wisely, and that's why we go to the targeted inflation index, or targeted index inflation reform that I'll talk about later. We regulate the issuance according to maintain the value of a price index. By taking away the private bank's ability to create demand deposits, we also remove the primary source of the boom bust in the economy. Which gets us into why the 100% reserve requirement on the banks is beneficial. That's a way of recapturing the public seigniorage that was taken away by the private bankers. It removes the bank's ability to arbitrarily expand or contract the outstanding bank credit. All genuine loans represent the lenders giving up money over the term of the loan. So in order to grant a loan for a specific term, a banker must have a time deposit behind that loan, not a demand deposit. The loan must be made out of genuine savings. Now there's 7 trillion in demand deposits outstanding in the country right now. That's the Fed refers to those as MZM, or money of zero maturity. And the banks conservatively earn a spread of 4.5% on that money. And that totals to 315 billion per year in seigniorage that the private banking system is capturing. That's money that should go to the state. So our reform would call for the banks to hold the state-issued currency behind these demand deposits. And this allows the state to substitute the issue of non-interest-bearing currency or state money for the interest-bearing debt. And by eliminating that interest payment on the debt, the government spending would be cut by about 315 billion a year. So with the 300 million in population in the United States right now, we're talking about a savings of about $1,000 per man, woman, and child in the United States, or maybe $2,500 per family. The U.S. government currently has 8.5 trillion in interest-bearing debt outstanding that costs the taxpayers 385 billion a year in service. To the extent that we can eliminate that, we've eliminated the federal budget deficit that they run each year. And the money is there in the form of this private seigniorage that the banks are capturing. Okay, on inflation targeting. It's really strange. I'm sure there's other speakers that are going to talk about this or have talked about this, but we don't trust the state with the power of money creation. So we force it to issue interest-bearing debt instead, which it sells to the banks, which the banks create the demand deposits to purchase. And then we, the taxpayers, in effect, pay interest to the banks and allow them to do the very thing we didn't trust the government to do. So not only do we transfer the wealth away from the community directly to the banks, but now we've ceded control over the money supply to the banks as well. So when they become cautious and don't roll over the loans, the money supply contracts, and when they become reckless and imprudently lend, they cause the malinvestment in inflation and sow the seeds for subsequent contractions. It's all very pernicious and dangerous. And it's especially egregious when it takes the form of the taxpayer paying banks for the new issue that could have been paid for tax-free and interest-free from the government. So when you advocate a large-scale reform like this, the knee-jerk reaction is we can't trust the state to issue the proper amount of money. And that's where the inflation targeting idea comes in. Most people agree that money should be a measuring stick, and the measuring stick shouldn't vary in value. And we can use this to our advantage, that stable prices appeal to people's natural sense of justice. Everyone's in favor of fair weights and measures. So we should emphasize that part of our reform measure. The current Fed chairman, Ben Bernanke, has done a lot of work promoting inflation targeting. He's written a lot of papers and spoken out publicly about it. He's a big believer in it, and when the time is right, I believe Ben Bernanke will push for its promotion. And I think his credibility is strong enough on this issue, and he has enough support for it in Washington that it will succeed, in spite of the fact that it takes away power from the Fed and makes it a more accountable institution. And I think we should support him in this move to inflation targeting. The benefits of inflation targeting: it serves as a counter-cyclical stabilizer. It represents the system of fair weights and measures for all. It aids in economic calculation and planning for businesses. It imposes fairness between debtors and creditors. It reduces the overall level of interest rates by removing the current premium the market prices in to compensate for the uncertainty of future inflation. And it ties the rate of interest more closely to the marginal return on capital and an economy's realistic growth potential. So it's a rules-based policy. It takes discretion away from any arbitrary decision-making on what the outstanding money supply should be. So in summary, the three reform measures are the state issue, the state monopoly on the issue of money, the 100% reserve solution, and the inflation index targeting solution. Now I'll talk just briefly about the parallels with the pension reforms that we've been advocating. As you are all probably aware, the market crash back in 2000 really hit the country's pension plans hard, both on the public and the corporate level. They lost hundreds of billions of dollars, and they went from surplus positions where the funding ratios were 140 to 150%, meaning they were overfunded, to deficit positions where their funding ratios were 70 to 80%. So they were in deficit by 20 to 30%. And this all just happened in a couple of years, faster than anyone thought possible. And as we analyzed what went wrong, the essential problem we identified was the failure of the corporate sponsors of these plans to recognize that the money that they promised to pay their employees in retirement is a debt obligation. And the consulting companies that advise these corporations and the entire public, the union, the whole pension system totaling $5 trillion, was oriented toward this idea that you can ignore the debt obligation. They don't need to take it into account except for in a very perfunctory way. And everyone was focused on just maximizing the total return on your investments and not seeing whether they were aligned to fund the employees' retirement. And what we recommended is that they put their pension liability front and center and make it the driver behind whatever contributions they made or their investment decisions. And it was, most importantly, it was the benchmark for how they were to evaluate their returns on their investments. And there were a handful of folks across the country. I wasn't alone in this. I was privileged to be a part of it from the beginning, but we basically called the corporations on it. And it seems simple now in retrospect, but at the beginning, it was a very foreign idea to people, and it threatened their livelihood, and there was a lot of rancorous discussion and debates about it. They're just, as I said, they were used to just comparing one asset to another and picking the best asset. You invest to maximize your absolute return, and the idea we introduced is that you compare your asset returns to your liability returns as a way of measuring your performance. And I remember sitting down with a prominent consultant from the West Coast, and he says to me, everything you've said makes sense, but how do I explain this to my board of pensions that we advised? They're used to the old way of doing things. So I boiled it down to this. Formally you gauge your success as the ability to find managers that were able to beat the market. That was the signal of success for successful investment managers. They were able to beat the market. But the market wasn't an appropriate benchmark. The benchmark was the liabilities that you need to pay your employees. So I would say to you now, the new benchmark is to fund your employees' retirement. My investment objective is a debt obligation to the employee, and when I beat that benchmark, I funded his retirement. But now that this is becoming more and more widespread, and actually the accounting profession is getting behind it, and they're going to require the corporations to record the liabilities on their balance sheet and flow the results to the income statement. The predominant response we hear among the pension plan sponsors is, we can't afford this anymore. Now that we've lifted the veil and uncovered what the wizard was up to behind the curtain, they tell us they can't afford the pension plan anymore. So they almost universally want to get out of the business, as they put it, and they're without any moral qualms around this. And there's very little protest about it, but in effect what they're doing is they're just shifting the risk to the employees now. And we know from our experience with the defined contribution plans, where everyone manages their own accounts, that most employees don't have this knowledge or the skills or the inclination to manage their own money. And so we're going to have a whole generation here that has insufficient savings to fund their retirement. But even if we're all very smart and self-reliant and investment people, it still wouldn't be rational for every individual to provide for his own retirement. Why is that? It's rooted in this reality that none of us can evade. None of us know how long we're going to live. I could walk out of this hotel after the meeting and get hit by a bus, or I could live to be 100. Yet our statistical models, and thanks to the work of the actuarial profession, we know with great certainty how long on average we will live. And so for this reason alone, retirement savings is ideally suited for collectivist risk sharing. Now, when I point this out to some of my libertarian friends, they say, well, if you don't want to outlive your savings, you should plan to your savings and accumulate enough assets so that you can live to be 100. You don't have to support yourself all the way till 100 or more. Well, first, this disregards the concern for other people in the community. We can't all work, we can't all accumulate enough assets to live to be 100. Maybe some of the libertarians can live that long, but most of us cannot. And secondly, this is not an optimal solution for society. It results in oversaving, and it's an inefficient use of resources. So the issues that the reform issues that we apply to the pension plans are very similar to the money and banking reforms here. We tie investment returns to the potential returns from real wealth. Soddy's very good at identifying the sources of real wealth in the physical world and its potential, and the physical assets decay and rot, and that's why Mr. Potter wants to convert his assets into debt instruments that can compound geometrically over time. But when you look at the potential for investment returns, it's very much tied to our ability to grow the assets, and the physical limitations of that are something more like 2 or 3% a year, not above inflation, and not some of the estimates that we are trying to hit with our retirement savings of 8 to 10%. It's just not realistic. So we identified the plan sponsor's promise to pay as a debt, and this liability is represented as a measurement of the performance in the assets. In the same way, the money is an offset or measurement of the real assets in the economy. And we're trying to, the reform also seeks to collectivize the risk sharing against the attempts to shift the risk to the individual. I'll wrap it up here in a minute. So I think that Stephen's work on writing the law, science, and money, and the American Monetary Institute is the direction we all need to go. And I commend you all for your active participation in the AMI, and the efforts you've made to attend this conference. And as documented in Merrick's book, one I referred to as a biography of Soddy, Soddy was actively involved in a wide variety of reform groups throughout the last half of his life. He was strongly committed to two groups called New Britain and New Europe that called for a peace in Europe and a single European currency. And both of these aims were realized through the European Economic Union and the Euro currency in 1999. But as Stephen has eloquently written about, it was very imperfectly implemented. But on this issue as well, Frederick Soddy proved himself a prophetic genius. But a consistent pattern emerges, I'm afraid, if you look back in history, that the true prophets are ignored and scorned in our lifetime, and it's only after their lives are at a safe distance that we are able to recognize the truth that they freely offered us. Financial panics are frequent in our business, and there's the old quote from Rothschild that says, you buy when there's blood running in the streets. And the meaning is this, is you always want to do the opposite of conventional wisdom, that the crowd is untruth. So today the conventional wisdom is that there's nothing wrong with our banking system, and there's nothing wrong with the way the Fed operates, but we in this room here know better. So when the thing breaks down and everyone is panicking, remember to keep your head, just like George Bailey did on His Wonderful Life, when he was calming down the crowd as they were making a run on his savings loan. What did he say? Potter's not selling, Potter's buying. So let's not be Potter's puppet. Let's be George Bailey's. Thank you.
Do
you want to
What are
ask questions?
the portable lights?
Sure.
I'd like to thank you for a really great talk.
Thank you.
Actually, the best in years. I love the skill, actually. A couple of quick questions. By the way, Mignon McLaughlin said, society honors its line of conformist and dead troublemakers.
That's very good.
So you're one of those troublemakers. I'd like to ask you the question about the whole issue that's cropping up today, and that is the pension issue overall. And not just the PBGC's $23 billion that they're in the hole, but some of the things, there's a group in Chicago, actually I'm a member of it, the American Society of Pension Professionals and Actuaries,
Very good.
and they start talking about the huge problem of the underfunded pensions, as you're starting to talk about a little bit more honestly, and especially problems in cash balance plans and others, which are truly smoke and mirrors,
Right.
where they may only have 30 cents on the dollar for every promised dollar down the road. I mean, it's an amazing con game.
Yeah.
Can you tell me if this opens up an opportunity with some of the problems cropping up down the road to move in this direction you want to move into, which should have been done many decades ago?
What creates the opportunity?
The basic collapse of both the private and also state and governmental pension plans. The top 125 state plans, as you know, probably 178 million in the hole right now.
Yeah. Well, the crisis did wake people up, and reforms are moving forward. Unfortunately, in this country, it's just amazing how many financial ostriches we have. In Europe, when they were subject to the same crisis, they were very quick to reform. I mean, I think when you start talking about eliminating pension benefits in Europe, you really get people's attention. And I work with a guy from Holland, and he says they take their retirement very seriously over there. And in Holland especially, they implemented measures immediately to make their pensions more fully funded. And they implemented these liability benchmarks that I've been advocating. People in the U.S. are just too trusting, that this is going to be taken care of when we're not addressing the real problems at all. So I would have hoped the crisis would have spurred us to action, become more fully funded on the pensions, but so far it's been very slow in the making.
For us younger investors, as companies drop their pension plans, and like a company I work for doesn't have one at all, I'm just wondering what methods or maybe investment techniques, I mean, you can use Roth IRA, 401ks, those type of things, and what do you suggest for people who don't have a pension plan, who work for a company that doesn't have a pension plan?
Well, the most important thing is start saving early, as I'm sure you're aware. But, the real problem with the risk shifting away from the defined benefit plans where the employer would take care of it to the defined contribution plan where it's basically the individual's responsibility. The main problem is that over half the employees don't take advantage of the defined contribution plans, and usually they have a matching provision, so you're already making 100% on your money right up front. Now, the latest pension reform proposal out of Washington is designed to make obligatory your participation in the defined contribution plan. So that's a step in the right direction, I think, because if you don't make that obligatory, I mean, so many young people say, we're talking 40 years from now, I may not be around that long, or it's just too far in the future to forego what I'd like to be spending today compared to saving for the future. So I'm afraid this is an issue that you have to force people to save for and make it obligatory. And in terms of, I don't have any secrets of investment success on how you should invest your money. The most important thing is just to start now and begin to save as much as you can.
Hello. Thank you very much for your honesty. I come from Britain, and as you probably know, we suffered quite a bit at the same sort of time. And the government decided they would have an investigation, Lord Turner investigation. And it quite confused us all by not stating clearly the difference between public and private pensions. But as all governments do, we'll solve this thing in 2020. And Tony Blair ain't going to be around in 2020. You're not going to be around next year for the sound of it. But it all started with us, as you know, with Captain Bob Maxwell taking a dive off his luxury yacht and getting a newspaper called the Mirror Group, which he owned, and his pension fund blind. And as always happens in these things, it's even now, it's the 55-plus-year-olds that suffer. There's nothing, I'm a good deal older than that now, but there's nothing that the 55-year-olds can do to start saving now. It's too late for them. So in the British context, and I feel very vulnerable here that obviously you know more than I do in this, I just wondered if you'd care to comment on any particular aspects of the British pension scheme.
Well, you can say the British pension scheme.
Well, as it is.
No, I know. I just love that phrasing because it's a little more honest than what we do in the United States. It is a scheme, usually, where so many of the corporations and the investment managers are able to skim the savings for themselves. And I have a great appreciation for the system over in the UK, and well, for one thing, they appreciated my work, so I appreciated them. I was invited to speak over there a number of times, and as I said, Europe is much more advanced in their thinking about this than the United States, and they implemented the reforms in their accounting profession way back in 2002 that forced the corporations to recognize their true obligations on their income, on their financial statements, and that changed the behavior of the corporate plan sponsors so that they would invest more wisely. And when we talk to U.S. corporations about implementing the necessary changes, they always say we don't need to do it until the accounting rules have changed here. And finally, we have Financial Accounting Standards Board here in the U.S. Moving to implement the same reforms that you have in the U.K. and that are widespread throughout Europe. And so we're catching up to you.
But those that got cheated out of pensions before 2002 are not being compensated.
Right.
Those after, I can't remember the percentage, but they might get a small percentage, it could be 50 to 80%, and that's all. But as usual, governments everywhere duck out of the responsibilities.
Oh yeah, and there's a number of sad stories. I have a very good friend, and I live out here in Wheaton, Illinois. I just on the phone with him last night, and he's a former United Airlines pilot, and he's 63 years old right now. He retired 5 years ago, expecting a full pension of $105,000 a year. As many of you probably know here, United Airlines declared bankruptcy for the sole purpose of shirking its pension obligations, put them over into the PBGC, the Federal Government Insurance Corporation, and the maximum the PBGC will pay on the pension is $43,000. So his retirement income went from $105,000 to $43,000 through no fault of his own.
I'm another Briton. Steve, yes, but you're the reason why I wasn't going to come. My wife ganged up on me because I'm fascinated to ask you, how come somebody who studied Frederick Soddy can, what has this done to your confidence in pursuing your trade? Because as you, I'm sure, will tell everybody, what Soddy finally arrived at was saying, you cannot save wealth. I'd like to discuss this with you about what it did to you and what you're now proposing.
Well, we all have to live within the system that we're living in. It doesn't make any sense for me to drop out. But the kind of reforms that we're talking about implementing, which are the kind of reforms that Soddy advocated, aren't really on anybody's radar screen here in the United States, other than the inflation index targeting reform, the reform of the private banking system, or making the state the sole issuer of money. Nobody cares about that, except for this small group here. So what are you going to do other than continue to talk about it honestly, speak out when you have the opportunity? That's what I'm doing.
Yes, indeed, because you talk about here, and as far as I know, you're the only person in the States that I know of. Turned up. I only know of one person in the United Kingdom who knows about Soddy.
You're the only person that I know of in the States, and it's the reason why my ears pricked up, and I thought, somebody in the States has read Soddy. I only know one person in the United Kingdom who has. And what he finally came up with is something which it runs a cart and horses through the traditional ideas about the idea of saving money for your old age. The idea of putting aside money now to have it magically appear in 40 years' time plus its increase is cloud cuckoo land. In fact, it's gambling. In England, people who take your bets are called bookmakers, and I personally think that the pensions industry in Britain are bookmakers.
Well, what Soddy would point out is that the idea that we can accumulate investments at compound interest over a 40-year period of time and as a society, have the wealth behind it that it can accumulate at compound interest rates is an illusion. The wealth, physical wealth, does not grow at compound interest rates. So you're absolutely right, but this idea of saving and making your interest compound is widespread throughout the land. There's nobody that really refutes it. The whole investment industry is built around it. Now, in terms of nobody knowing who Frederick Soddy is, I will point out, his books are still being published. You can still buy them. Virtual Wealth and Debt. Herman Daly, who has written a number of books on environmental economics for the common good. In his second edition of For the Common Good, he has an appendix on money where he talks extensively about Soddy. And he's also got a chapter on money and ecological economics where he talks about Soddy. So he's getting the word out.
Okay, now,
One second.
you ready? Gentlemen want to know, did no one know about Frederick Soddy? I wrote a book in 1971 entitled Unforgiven, and I had quite a section in there on Soddy. Of course, my interest was that the beginning of wealth was the revenue we harvest from the sun through the agency of commodities that we grow, that we then monetize. I'll be talking about that later on Saturday. But there's quite a number of people, including all of our readers, who are quite familiar with Soddy in the United States. This is Acres USA speaking.
Oh, that's great. No, I have 3 more pages in here written about the difference between physical wealth and debt, and I just didn't have time to work them into my talk. But you're absolutely right. At the beginning of Wealth, Virtual Wealth, and Debt, Soddy's main piece, he spends the first 3 chapters talking about the physical properties of wealth, and then he goes on to money and debt.
Your thoughts about derivatives, the exponential growth of derivatives, and like Warren Buffett's comments and whatnot. Are you fearful of like Citigroup and JP Morgan Chase and things like that if there was a severe downturn of some sort?
I don't know. I mean, they've been around for a while. My own firm, we're very actively involved in derivatives. Do they provide a system, or do they make the economic system more risky or have a destabilizing effect? I'm not quite sure about that. I think for the most part they're offsetting positions. For instance, Amaranth has been in the news the last couple of days on a large hedge fund that went under, lost 50% of its value in a very short period of time when natural gas fell by 15%. And the reason it hasn't spilled over and didn't cause the financial contagion is because there was these offsetting positions. For every buyer there was a seller, and if as long as it doesn't impact the banking system, the fractional reserve system, I don't think you have this this contractionary effect that could collapse the economy. So there may be ways of dispersing the risk and diversifying the risk among more people and making the system as stable as some of these as the destabilizing effects. So it's not clear to me. I mean, they've been around for a long time, and the financial markets are actually less volatile today than they were 5 years ago. So, and as you say, they've grown exponentially over the last 5 years. It's not clear.
One other question too. Are you concerned at all about a currency crisis? If China and Japan just decide that we're not credit worthy anymore, that our debts are just, the negative savings rate, the federal deficits, the balance of trade deficits. Are you concerned at all about that?
Concerned, yes. Do I think it's a high likelihood event? I would put it at a remote risk. I think the Chinese and the Japanese have been accumulating dollar assets because it's in their interest to accumulate the dollar assets, and I don't see them dumping them anytime soon.
David very much. And I'm looking forward to hearing the CD on that again. Our next speaker is Mr. Richard Distelhorst.
That's part of the problem, being 85 years old.
Dick Distelhorst, aside from that step there, is one of the most energetic people associated with us. He's from Burlington, Iowa.